All right, taking you on a little tour through all my waffle long sleeve shirts. All right, screencast number 5 called the Money Multiplier. Now, last time what we saw is that when banks make loans, they create money. What we're going to see now is that when banks make loans and create money, that money actually gets multiplied through a process called the Money Multiplier process that winds up creating even more money. And this is a lot like the spending multiplier process that we talked about back with fiscal policy. But instead of talking about spending that gets multiplied, here we're talking about actual money that gets multiplied. And we'll see how that process works right now. So let's take the example, a similar example that we saw last time. Let's say that a woman named Kim, I assume it's a woman, takes $100 out from under her mattress and deposits it at her bank. We'll just call that Bank A. Let's also assume that the reserve requirement is 20%. Remember, that's set by the Fed, and that determines how much excess reserves there'll be and how much banks can lend out. Finally, we'll assume that banks hold no excess reserves, which means that they lend out as much as they can possibly lend out. First, a couple of calculations. Required reserves here would be $20, 20% of the $100 deposit. So that's what they have to keep in the vault. The rest of it, $80, would be called excess reserves, and that's how much money the bank could theoretically lend out. So Bank A could lend out at most $80, and what we saw is that when the bank lends out $80, it's creating $80 in new M1 money in the form of checkable deposits. That is not the end of the story, because as we're going to see, that $80 is actually going to turn into a lot more new money. Let me take you through the process. Starting with Bank A, Kim deposited her $100. The bank took $20, put that in the vault. Those were required reserves. The excess reserves were $80, and that's how much the bank was able to lend out, $80. So that's 80 new dollars of M1 money. Now, theoretically, whoever took out that $80 is going to go spend it somewhere, maybe at a sporting goods store. That sporting goods store also has a bank that they keep their money at. So when the $80 is spent at the sporting goods store, they take their money down, $80, to their bank, which might be Bank B. They deposit that $80. The bank takes 20% of it, which is the reserve requirement, or $16, puts it in the vault, and the rest of it would be excess reserves, $64, which could also be lent out. When that $64 is lent out, that's another $64 in new money that gets created. It gets spent somewhere and then theoretically redeposited in the next bank, Bank C. Bank C would take the $64, take 20% of it, throw it in the vault as required reserves, take the excess, which would be $51.20, and then lend that money out. That money would then get redeposited, and etc. What would happen is we'd go through a series of banks and a series of lending out, redepositing, lending out, etc. And eventually, in the end, that money is turning into a lot more new money. In fact, if you look at the final column, you can see that that original $100 deposit actually turns into quite a bit of new money. 80 plus 64 plus 51.20, and on it goes. Now we can go through a table like this to figure out exactly how much new money gets created. Alternatively, and preferably, we can use a couple of formulas to figure out the same thing. So the first formula is for what's called the money multiplier. And it is the multiplier we're going to use to figure out how much new money gets created. The formula for the money multiplier is 1 divided by the reserve ratio in decimal form. The maximum checkable deposit expansion, or another way of saying that, the maximum amount of new money that can be created, new loans that could be lent out, is equal to the excess reserves of that initial bank deposit times that money multiplier. Again, maximum checkable deposit expansion, think of that simply as the maximum amount of new money that can be created by the banking system as a whole, as that money gets lent out, redeposited, lent out, etc. In our example, the money multiplier would be 5. Since the reserve ratio is 20%, we would simply do 1 divided by 0.2, which would give us 5. You'll remember that when Kim deposited her $100, they took 20 out of it as required reserves and 80 were excess reserves. So if we take that 80 and multiply it by 5, we can figure out that it's going to create $400 new dollars over the course of the entire system. In other words, if we went to that last column again and added up all of the numbers for all of the banks involved until the process was done, that would turn into $400 in new money. Now, there are some limitations to the process. The first limitation is obvious, the reserve ratio set by the Fed. Again, if the reserve ratio is 100%, that pretty much ends the entire lending process entirely. Even if the reserve ratio isn't 100%, there are leakages involved, and we've seen this word before. First off, currency drains. All of this kind of depends on people taking out loans in the form of checkable deposits. If they were taking out loans in cash instead, the process wouldn't quite work the same way. Secondly, banks may not choose to lend out all of their excess reserves if they particularly think the economy is going to be bad, for example, and that people won't pay them back. They might not choose to lend out all the money that they could potentially lend out, and that would be another limitation to the process. So let me give you a problem or two and see if you can figure out how to go about solving it. Let's say that Selena finds $1,500 in cash on the street, deposits it at Wells Fargo Bank, and opens up a checking account. And let's also assume that the reserve requirement is 8%. Two questions here, and see if you can figure out each one. First, how much could Wells Fargo lend out as a result of this new deposit? And therefore, how much new money could Wells Fargo create? And secondly, once that money is subject to the whole money multiplier process, how much could the entire banking system create as a whole? Maybe I want to pause the video here and see if you can figure it out. 3, 2, 1. All right, let's deal with the first question. How much can Wells Fargo lend out? Required reserves is equal to the reserve ratio times the amount of deposits. Here the reserve ratio is 8% and the amount of deposits are $1,500. So required reserves would be $120. That's how much they have to throw in the vault and keep it there or keep at the Federal Reserve Bank. Excess reserves would be the difference. So $1,500 minus $120 means $1,380. That's how much Wells Fargo could lend out, and that's how much new money Wells Fargo itself could create. As to the second question, how much could the entire banking system create? Well, we have to figure out what the money multiplier is. 1 divided by the reserve ratio, or 1 divided by 0.08 is equal to 12.5. There's our multiplier. Multiply that by the amount of excess reserves, which we just figured out was 1380. And we can determine that the entire banking system as a whole will be able to create $17,250 in new money. That's how much that money supply curve in the money market graph is going to move if the entire multiplier process works. And so the Federal Reserve has to think about that as it's thinking about where to move that money supply curve in order to change interest rates. It's got to factor in the fact that money gets multiplied and it's not simply equal to the amount of the initial loan created by that first bank. So you might want to think about the implications here. What if you're the Federal Reserve Bank and you've determined that you want 200 billion new money to be out there in the economy, because that's how much you want to move the money supply curve to get to the interest rate you want to get to. Well, if you're the Federal Reserve, and if you could increase the amount of excess reserves that banks have, you could have them loan out money, which would get multiplied in the money multiplier process, which would create even more money, and that would move that money supply curve by a certain amount. So what remains is to talk about, well, how does the Federal Reserve do that? How do they change how much excess reserves banks have, and therefore change how much money gets created, change the money supply, and change interest rates in the economy? And that's where we're going to be going next time.
Damn it, this is too hard! Here's what I think of your test, Mr. Teacher!